Well, hello and welcome. It's that time of the year where we get you the best market opinion, and we've done that throughout the last 1 week. But we haven't gotten you the opinion of the marquee brokerages. What are the think tanks of those brokerages thinking about the Samvat gone by and the Samvat ahead? Will it essentially be a year and a Samvat of earnings catch up? And will it continue to be a Samvat of mid cap and small cap outperformance? That's the question that we pose to two of the largest brokerages on the domestic circuit, and the two think tanks, the two men who run the train thoughts out there, join us right now on the show. Need no introduction, Vikas Khemani and Saurabh Mukherjee. Thank you so much, gentlemen, for joining in. Vikas, let me start off with you. Samvat 2072, the one that's gone by. You can argue that it was a year or it was a Samvat marked with a number of events, but you would have to say if you're an equity investor, you've probably turned out on the right side of the bed.
Absolutely. I think, we have had approximately about 10% odd returns on Nifty, on Sensex. But I think, given the fact that we had a little bit of global turmoil happening, and I think, Indian economy was through a transitionary phase. Government has been putting through lots of reform which will have far-reaching impact. So I think we were passing through a transitionary phase. So I think because of that, probably still it has performed little less than the expected what we had from last year. But I think I feel that by and large it has turned out to be okay. More importantly, I think it also leaves a lot of hope for the time to come. As Indian macros are sort of panning out, as government's efforts are sort of trickling down in the economy. So while we should not be too much bothered about the disappointments of the past, but I think looking forward, I'm quite optimistic. We are quite optimistic about the Indian economy and equity market in particular.
Saurabh, your thoughts?
I think, last year, this time, we were all a little subdued. Markets had started coming off since August 2015. And I remember last year, this time, on a similar show a year ago, we were very circumspect on India. Clearly, in the 12 months, the mood has changed. And specifically, I think for the consumer sector and for the consumer financing sector, the cost of wholesale money has fallen so much that it makes a lot of sense to be bullish about consumption and the financing of the same going forward. Also, we got to be realistic. India is a large democracy. We're going into the busy part of our India's 5-year election season. Lots of big state elections coming up through 2017, and then 4 big state elections in 2018. Highly likely, therefore, that the government will stimulate consumption going forward. If you put it all together, I think we're heading for a cracker of a 12 months for consumption and the financing of the same.
What would that mean for markets, market levels particularly? I mean, have you upgraded your market targets or are in process to doing so? One of you could go.
So look, back in June, we said that by the end of fiscal 17, the Sensex should be at around the 30,000 mark. We're clearly approaching that. I'm not so sure that there's enough grounds as yet to upgrade our Sensex target. Earnings aren't really picking up, and the banking system, especially on the NPA side, the banking system has plenty to worry about. So if you ask me over the year ahead, will I say 10% upside between now and next Samvat? Perhaps not. But what's becoming very clear is what should you buy in India if you really want to make money over the next 5-10 years. Consumption stocks, auto, consumer durables, and consumer finance names. There are, I would say, between 50 to 60 names in these 4 sectors, which are looking very tasty, and we'll be pushing our clients towards those names over the next 12 months.
Vikas, would you be looking at upgrading the index?
I think so. I definitely am very, very constructive about Indian markets, and specifically, I think whatever has happened in the last 12-18 months, the impact of that will start trickling down into corporate earnings, and to a great extent, we've already seen. And I do believe that corporate asset quality in the banking system will start looking, upwards post RBI's latest scheme, and I think uptrend in the economy. So I think that part is a very big part contributing to, in my opinion, overall economic revival and markets. And secondly, I do believe that I think we've been so far operating in a global headwind kind of environment. I believe that we will start seeing a little bit of improvement or positivity from the global sides. So I am quite positive, and obviously you've got to be stock specific, sector specific. All those things needs to be sort of kept in mind. But I won't be surprised. I would say there will be high probability of Nifty hitting 5-digit mark somewhere in next 12 months, and I guess that would be about 15 or 18 odd % return, and that's quite possible in next 12 to 18 months, and that means that there would be pockets, there would be sectors which will give much better return than average number. So and more importantly, I think you will see lots of money coming to Indian markets, unprecedented money coming to Indian market, both from domestic as well as international. So I think you have a good liquidity environment, you have good fundamentals improving. So, and also I feel that there will be broadly global environment supporting this whole issue. So I guess we are very, very positive.
Now, Saurabh, the thing is that somehow to our mind and our conversations with people, the beauty for the next 12 to 24 months could well be that even if the index doesn't go up, but if it stays stagnant and doesn't really go down too much, there is enough and more available on the non-Nifty 50, non-Sensex 30 names. Absolutely. In the large cap space and in the mid cap space. Absolutely, as well to do. Yeah. Now you've outlined the spaces, and we'll get to that in a bit. But the other very crucial thing for this market or the next Samvat could well be the biggest tax reform that we've arguably seen in India coming to the fore. How well does that portend for sentiment and stock picking as well? Because that will have a big impact on the way specific spaces within the market moves as well.
So look, I mean, a big part of the GST positivity we've already baked into the markets. Clearly, hopefully a year hence, high chance that a year hence we'll already be in a post-GST world. And as is reasonably clear, the big winners will be large organized players, whether they be in auto, consumer durables, electricals and so on. They'll pull away market share from the unorganized sector, and big market share gains, big operating margin gains over 2-3 years for the organized players in a whole host of sectors. Where I think the challenge lies, and this will become increasingly apparent over the next 12 months, is I think capital goods purchases, say purchases of trucks, purchases of machinery, might get a little slowed as corporates try to figure out what exactly does GST mean, how will India's supply chain architecture claim, how will India's supply chain architecture change. I think that'll actually be a buying opportunity. So potentially you've got a 12-month period where some of the more prominent truck manufacturers, capital equipment manufacturers domestically could see a slowdown in business as corporates just pause and try to rethink their plans in light of GST. That I reckon will be a buying opportunity in these names. We're really looking forward to that actually. But more generally, what will be a big trade in the next 12 months, and you'll see repeated earnings upgrades, is for the organized players, whether they be in footwear, auto, electricals, durables, plywood, name it. There's a whole spectrum of names where corporates will become more and more confident that the unorganized players are going to die away. In several cases, I think the unorganized players will go to the organized corporates and say, buy us out, we don't have a future in the post-GST world. Again, reflecting that, I think you'll see government announcements on policies to deal with unemployment. As the unorganized sector gradually shuts down, there will be a real threat of unemployment, and therefore I think in the coming budget you will potentially see the introduction of universal basic income by the government to counter the unemployment threat. So in terms of structural change on a 12-month basis, hard to think of 12 more exciting months. Massive tax reform getting implemented, big changes in corporate India, and I think you'll see a big change in the government's stance towards subsidies and welfare, especially around universal basic income in the forthcoming budget.
What I just that limited point, I think the conversation with IT companies also seems to suggest that there will be something dramatic that the government will do in order to tackle the unemployment thing, because I think more and more IT companies are saying that while they will probably contend with these current headwinds, there will be a loss of manpower from these IT companies, because automation will lead to that, and therefore Make in India needs to succeed now more than ever before.
We'll have to see. No, but on GST, the whole format in which GST is being implemented, now they're talking about a 4-tier tax rate, right? Which is a departure from the fixed rate, which was supposed to be the model adopted. So in a way, you've not got the GST that one was hoping to change the way business is done in India. Do you think that that would also in some way scale back what that does for overall earnings, for the overall earnings environment, especially from the consumer and the logistic companies? Because it's not being implemented in the manner in which one had thought initially.
See, I think one has to keep in mind GST is a very, very structural reform, and it's very, very contentious reform. I mean, a lot of countries like USA has been trying to do that, they have not been able to implement. So I think when you are implementing something like this, you have to keep in mind, realities like inflation, what impact it will have on inflation, what impact it will have on various stakeholders. So I think rather than writing of that we will not get the perfect law. I think it's good beginning, and once you make a beginning, I think there are lots of ways to change. It's like this: when we implemented service tax, when we implemented VAT, all those things were sort of considered chaotic at that point in time. But in 4 or 5 years time, all these things become fairly par for the course, matter of fact. And I think that the same thing will happen. So I think first year of GST implementation could be chaotic, could be in some sense disruptive or unnerving for the industries. That will create, and when you interact with most of the corporates, they also don't know what implication it would have for them. But that's fine. I think that's kind of 1 year, 1.5, 2 year phenomenon. But that does not mean the demand will go away. That does not mean that corporates will not be sort of doing the normal business. So all those things will happen. So I am not a
but what would that do for earnings for FY18 in this transition period, in this uncertainty? Would earnings go higher because we are already in a slow earnings phase? So in that adjustment period,
it will be industries to industry specific, what rate applies to whom and all those things. But by and large, I don't think, in my opinion, it will be harmful to earnings. It will, by and large, I mean, there could be industries and companies I don't know, but by and large, it will be positive for the companies. And if you see, government is talking about having some sort of cess to make up for the revenues and all those things. So I think, in my opinion, at best it will be neutral or positive.
Let's talk about what are the spaces which will drive the earnings growth. This Samvat, we're talking about the next Samvat, because you mentioned that earnings will pick up. What leads this earnings recovery? It definitely is not going to be IT.
Oh, sure. I think, in my opinion, next 12 months, corporate, lending banks would do significantly well. In my opinion, I think one sector, if I were to say, believe will deliver significant returns from share market return perspective as well as the earnings perspective, I think would be corporate, facing banks. We have seen retail-oriented banks doing very well, but I think the key hypothesis being, the asset quality improvement will start happening partly because of the implementation of the new RBI scheme, and secondly, we've already seen some large assets getting resolved, economic recovery starting to happen. So I think that is the one segment I do believe will do very, very well over next 12 months.
So before you continue your answer, I don't want you to give names, but do you think the troubled ones, the hitherto troubled ones, the likes of Axis, ICICI, have better potential to do that? Or do you think the more stable ones until now, the likes of say an HDFC, I would classify the corporate.
Those are not really, they have corporate exposure, but I think they are more or less, they have large retail exposure. And still, since the hypothesis is a significant improvement in the asset quality, naturally those are the ones which are significant beneficiary of that, because unaffected ones are anyway doing very well. So I think big delta, in my opinion, will come in some of the public sector banks, some of the banks which are focusing on that particular, the exposed to particular segment of borrowings. So I feel that can do very, very well. And second segment, which has been my favorite segment for quite some time, is the EPC or construction segment, which I think we've seen order book of this these companies significantly ballooning and building up, and earnings and revenue growth will start accelerating from here. I won't be surprised if some of these companies end up reporting 25 to 30% plus kind of earnings growth and revenue growth over next couple of years. So you will start seeing these companies doing very well, and by nature there are many mid-cap companies in that, but that segment, in my opinion, over the next 5-7 years will become fairly large, because if you see, government is spending huge amount of money across the nation. If I were to give an example, even Bombay itself has 1,70,000 crores of projects going live in next couple of years.
I dare say we need them.
So, but I mean, that's one city. So, you will see, you don't have many companies doing well, and structurally this business has improved from a capital efficiency perspective, from corruption perspective, from working cycle perspective. So I think, I feel that segment will end up doing very well.
Okay. Saurabh, you don't think it's a year of significant earnings recovery. However, what do you think will lead earnings growth wherever it comes in? Consumers?
I think where we're seeing the signs of recovery are in the consumption space quite clearly. Say two-wheeler consumption last 6 months, you can see the growth rate for two-wheeler consumption pick up quite materially. Similarly, if you look at the car segment, last 12 months have been good. What's also happening is, because the wholesale cost of funding has dropped very sharply in the last 6-7 months, the non-bank finance companies have cut their lending rates to consumers. So financing of consumer durables and auto has become much cheaper. In fact, the 8 years I've lived in India, I've never seen car, two-wheeler and durable finance being this cheap. So consumption, I think, will be the way ahead. I'm not so sure the corporate banking stress will alleviate. A lot of these deals that are being announced are largely cosmetic deals. We've done a fair bit of work on the beleaguered banks, the stressed banks, and my reckoning is for 2 more years, the stress in these banks' balance sheets will continue. Where the BFSI universe, where the financial services universe will clearly move ahead, accelerate its growth, is on the consumer durable and the consumption financing piece. As I said, this year, because consumption is only 50-60% of the story, this year I don't think there's an EPS growth story, the EPS pickup story for the market. Next year, as the negatives from the capex drag down reduce in the year to March 18, you could potentially see a recovery. But I think India remains very much a consumption-driven story for pretty much the rest of the NDA government's life. I really can't see the capex story coming back, nor the banks who lend heavily on the corporate side.
E.g. ICICI Bank?
As I said, no stock names.
No, I know. But you've given a cue for taking the discussion forward on the whole stress assets business. Do you think a lot of factors are? I'm not saying this will clear up in 6 to 8 months' time, but do you think a lot of factors are coming together to at least start the process? And generally, the markets kind of have, move ahead of the curve. So, are we going to be what we've seen with the PSU banks over the last 3 to 4 months, plus ICICI Bank over the last 2 weeks? Do you think this is a move that can really reward investors over the long period of time? Because the cycle will play out, the cleanup will happen maybe 2 or 3 quarters down the line, and then it'll be too late because the market would have already priced it. Yeah, okay, sorry.
So I think the important point out here is that the markets have already seen elevated levels of stress, right? So markets are factored in worst, especially in these banks. Now, what's happening, it is important to note. One is, I think, large asset sales are happening. We have seen a lot of them, and I think we believe that a lot of them are real, and chunky ones are getting resolved. Secondly, what is happening in steel, like as the cyclical recovery is taking place, most of the steel companies have started, and with obviously government support on the import duties and all those things, which is again a very large asset, is sort of getting taken care of. Thirdly, I think recently you would have sort of seen government trying to work out for some sort of stress asset being bought out by PSUs. So you will have the whole kind of models getting implemented. Now, when that gets implemented, the reported number suddenly comes down. Fourthly, this new restructuring schemes. I think most of the SA4 ones will get implemented by, if not by December quarter. We will start seeing, not most, but start getting, if not by December quarter, but March quarter, June quarter. So you will start seeing the elevated level of stress NPA numbers coming down. And markets will take a clue from that. Markets will start looking at, because when they were going up, markets were punishing these banks. As they are sort of coming down, markets will take note of them, and that's very big reason. That's a reason why we believe that these stocks will do very well over next 12 months. Obviously, it will take 3 to 4 years for a complete recovery of this, because these are massive.
So you're bullish on PSU banks and largely the stressed
corporate
banks, banks exposed to corporate stress.
Corporate stress, yeah.
Okay. Fair call. So that's the view on banks, and let's kind of play a rapid fire. I think we have about 4 or 5 more minutes left. So let's try and figure out between Vikas, to you, between IT and pharma, anything that you think will do well?
I think they will give pharma has a potential to surprise, stock-specific surprise on upside, but I think IT, in my opinion, will give 10-12% kind of return.
Okay, Saurabh, you're the best guy to ask this because we can't ask this to Vikas. Brokerage stocks or diversified financial services names, they have had a really good run-up, but you understand the business. Do you think there is more in store?
I think there's plenty left. I think there's a huge shift in our country away from saving through jewelry and real estate into saving through the stock market, through financial instruments. And I think my competitors in other brokerage houses, investment banks, asset management houses, clients in asset management houses, hopefully as well, I think there's a terrific period ahead for this industry.
Auto components, Vikas? I mean, Vikas is beaming on that answer, but Vikas, auto components, do you think that space has more in store?
Oh, surely. I think long way to go, in my opinion. Again, I think auto, we have just seen the demand recovery, right? And you will continue to see that picking up, and especially, I think, in CV cycle, little bit of disappointment has happened, but as the more roads get built, more activity picks up, you will see demand picking up. So I think, from structurally, both these segments will definitely do well. We are quite positive.
Also the scrappage policy, right? That'll be a big shot in the arm.
Yes, absolutely.
Okay, between consumer discretionary and consumer durables.
I think consumer discretionary will continue to have a strong year, where I think the dark horse which will really come back is consumer staples.
Okay.
I think consumer staples will stage a strong comeback. It's as it is, they're trading at elevated multiples, I know. But as I was saying, my hunch is the February budget will show that this government in a very new light in terms of wanting to give benefits to the more needy sections of our society through something akin to a universal basic income scheme. That will be a massive fillip for those stocks. My hunch is that the chief economic advisor will publish his mid-year economic review, and perhaps in that he will outline the universal basic income construct. And if he does that, I think therein starts a big up move in FMCG stocks, which I don't think the market's quite factoring in.
The fancy of the market the last 6 months, specialty chemicals, Vikas, do you think there is more in store?
A lot more in store. I think it's a structural story, and I think probably it could do what happened to pharma 10 years ago. So I think lot more scope to go. I think we've just seen there are hardly 8-10 companies which has, or I would say 3-4 companies which has some size and scale. So it has two levers. One is as domestic markets grow, need for specialty chemicals goes up, and also we are fairly well placed in export market. So I think specialty chemical has a long way to go.
And final thoughts, we can't just talk all good. There has to be something or a few things which will not do well. So what do you think, to your mind, definitely will not have a great Samvat 2073? Not everything can do well. Saurabh?
I think banks which have lent to corporate India. Serious.
So there's a dichotomy there,
I
that's
think
fine.
the trouble is just beginning. I think we'll see serious trouble there. I mean, on a more somber note, I don't think the government's really managed to get to grips with the problem. I don't think the RBI has managed to get to grips with the problem. And I think the banks don't do their cause any good by pretending as if they are getting somewhere near a solution. I think the more specific thing to focus on is, I think the smaller PSU banks, there's a real chance they get into some serious trouble this year. The larger banks at least have respectable brand. I think the second rung PSU banks, there's a real chance there'll be a train wreck there sometime in the next 12 months.
Oops. Vikas, final thoughts. What won't do well?
So I think difficult to put down, but I would assume that metals and all those things still pretty much global players, unless global plays still, unless we see some sort of pickup on global scale, we will have this kind of muted performance. Other than that, I think maybe to some extent upstream oil companies, but other than that, I don't think there will be too much of disappointment overall.
Great, gentlemen. Thank you so much for joining in and giving us your think tank's views on this occasion. And well, that's it from a beauty, a beast, and two very special minds. Wish all our viewers a very happy Diwali and a prosperous New Year.
Yeah, have a great year.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.